Hello, and welcome to our fourth quarter strategy review for 2023. We met on Friday the 22nd amid all the talk about possibly having the government once again freezing assets. We met talking about a lot of the problems that the government is having getting out of its own way. But notwithstanding, we did have a good meeting. We had three guests with us. Two of them were from Pacer funds, and Pacer funds are very interesting. Thanks to Bob, brought to our attention some time ago. They invest using a free cash flow model, and that has been very successful with one of our funds, which is we call cows, but they now have others that end with a G and end with an I and so on using this same concept. Anyway, very interesting conversation with their portfolio manager and talking about how this works, and very, very good outperformance from this concept. So we're probably going to tend to use more of it in the future. Also with us, though, was Corey Owens. Corey is a local CFP and CFA. He's with Kingsview Wealth Management, and he was very, very interesting in the fact that he not only was quoting a lot of the things that came from our research package, was able to refer to them specifically. Corey, by the way, is a millennial. Therefore, his memory is probably a lot better than all of ours. But in any case, it was a very good meeting. And of course, with us at the meeting was normally Len Skina, CEO and vice president of the firm, and of course, Bob Toomey, who is our research director and also vice president of the firm. So without any further ado, let me switch it over to Bob to basically talk about some of the equity exposures that we'll be experiencing in the next quarter.
Great. Thanks a lot, Stan. So I think Stan gave a nice summary of high-level overview of a lot of the important things we touched on at the meeting. But I know that when we do these reviews for you, I know a lot of you do have questions about, what's happening in the financial markets. And I think that's why we try to give you a little bit of insights to our views as to what we see going on. And I think currently, hopefully you're not spending too much time following the financial markets, have better things to do than that. But, September is kind of living up to its reputation a little bit as being a more volatile month. September and October historically have been the most volatile months of the year. Month to date, the market's down about 5%. It's down about 7% since the peak in August. And I don't really view that as anything to be overly concerned about. I think that's just normal volatility. The big concerns right now for investors, there are always concerns. As you know, the markets climb a wall of worry. Certainly, I think the economy is still on everybody's mind. Will there be a recession? When will that recession be? We've been hearing about recession now for the better part of 2 years, and it has not occurred. The other big concern, of course, being the Federal Reserve's monetary policy. So we did discuss those factors. The Fed, I think, is now sort of in what we call a higher for longer condition, if you will, short of them really not having any better idea of what's going on in the economy than you or us. And they, believe me, they really don't. I mean, they're data dependent. I think they want to err on the side of caution. So I think we're going to see interest rates remain higher than we expected for a longer period of time than we expected. And that is resulting in some valuation adjustments in the market, and that's what causes this volatility. Recent economic data is pointing to a slowing economy. Our committee agreed that we do think the economy is going to slow down. And I think that has implications for interest rates. It has implications for Federal Reserve policy. And we think the Fed is probably at or near being done raising interest rates. Time will tell on that, but we think that the Fed has gone a long way, and they really need to, I think, slow down a little bit to see how these interest rate increases will affect the economy. And I think that that's a longer term positive to the extent that the Fed is at or near a peak in raising rates. We believe corporate profits bottomed in the third quarter. That is also a positive for stocks. I don't see corporate profit growth taking off like a rocket next year. I think it's going to be a more subdued type of growth environment, which has implications for equities as well. Our bias towards equities remains positive, but I would not be surprised to see, some further near-term downside given normal seasonal effects. I would expect that gains in 2024 also would be a little bit more muted and more in line with the long-term averages than we saw this year. So with that, I'll turn it over to Len for some comments on fixed income.
Thank you, Bob. On the bond front, the Fed kept interest rates unchanged during their most recent meeting. They did indicate that they may not be done raising rates, and we see no reason not to believe them. Though we do anticipate, as Bob indicated, that they're getting close to when they may finally have rates to a point where they feel more comfortable about inflation. Given all of this, we're over allocated to fixed income right now, taking advantage of elevated short-term rates, while also recognizing that now seems a reasonable time to begin getting back into longer-term bonds while rates have gone through most of the hiking cycle already. And now I'd like to turn it back to Stan to talk about REITs.
Thanks, Len. REITs, of course, have been a stalwart part of our portfolio for quite a long time. However, with interest rates doing what they're doing, with the difficulty to get people to go back to their jobs at offices, and even the multifamily home situation is now being affected by the higher rates. REITs are not as attractive, and therefore we have reduced our exposure somewhat in that category. We still like REITs because, of course, they operate as a pass-through of all their dividends. So we continue to enjoy some relatively high dividends, but we decided to just stay with the primary US REIT and not venture away from it as we have sometimes in the past, and again, reduce that exposure somewhat. So with that, I'd like to turn it back over to Len to talk about the international.
Thank you, Stan. We're not as favorable on the international front as we are domestically. China continues to face headwinds that slow that economy, leaving the emerging markets an area that we're not comfortable dipping our toes in. As we see lower growth internationally than here, we have significantly decreased our exposure to the developed markets as well, dropping from a strong overweight position last quarter to a slightly underweight position there now. And then Bob will talk about the changes we've made in our model.
Thank you very much, Len. I do want to mention that I just want to follow up on Len's comments about international. We agreed as a committee that the Chinese economy is probably going to have a more difficult time than we had previously expected, and that affects not only Chinese stocks but also emerging markets. We have generally focused on international developed equities, but we feel it's prudent right now to reduce that exposure a little bit given the issues going on in China. We did slightly increase our bond duration by increasing our exposure to intermediate treasuries and our holding of the XLU, which is the SPDR utility ETF. We think that it's an advantageous time to be doing that as a result of our committee's belief that we are at or near a peak in interest rates. With respect to natural resources, we did increase our exposure there because we think that we may be in a longer term sustained commodities cycle, which will benefit commodities such as metals, agricultural products, forest products, and energy. And we added both to our core position in the GUNR upstream natural resources ETF, and also the XLE, which is the Spider Energy ETF. Finally, we also slightly increased our weightings toward value. We eliminated our position in the XLK, which is the Spider Technology Index. That had done very, very well for us, but we feel at this time we're going to be better positioned, focusing more of those funds into value, which has underperformed. And as Stan mentioned, we put most of that money into the Pacer free cash flow generating companies, the COWZ, or COWS ETF, as we fondly refer to it as such. We think that will be that would be a good place to be seeking value with your investment funds. So with that, I want to turn it back to Stan for closing remarks.
Thanks, Bob. And closing remarks usually always talk about the triggers. And just to remind all of you, triggers are things that we set in when we get through with our session, things that we don't expect to happen, but if they do, we made the decision in kind of the clear light of day. Well, last quarter, we wound up getting not one, but two of our triggers being activated. One of them was dealing with a positive, saying the consumer confidence index would rise. And the second was a negative, saying that we might get a downgrade of US Treasury securities. Well, much to our surprise, those happened 2 days apart. So on the one hand, we were looking at a positive, and then we were looking at a negative. It did make sense, and actually there was some value in moving actually out a bit because of the downgrade. And of course, we have experienced some negative markets over this last quarter as well. So what are we doing this quarter? Well, we're going back to consumer confidence index. We are thinking that it was maybe a head fake that happened in the last one. So we raised it. We're now looking for the consumer confidence index to rise above 80. And we are also concerned about some of the inflationary pressures that are out there. But again, not too concerned, but we did set a trigger for that. And this one was something we talked about quite a bit, because the question was, if we experience CPI rising 1% for a month, that would annualize out at 12%. Again, seems highly unlikely, but we're using that as a trigger because when the Fed first started raising rates, you may recall everybody was talking about, oh my God, we've got a 10% number. Well, we never really saw that 10% number, but we did see it on a month-by-month basis early on. So we're concerned about that. Again, remember, these are things we don't think are going to happen, but we want to be prepared for it if they do. And then the other one was to say, if the Fed succeeds in getting CPI down, and here we're saying at an annualized rate of 3%, then that would be a positive trigger for us. So again, we're not looking for these things to happen, but that's what we make sure that we make decisions now rather than having to make them when, you know, Fitch is lowering bond ratings and things of that nature. So with that, have a very, very good holiday. And we will look forward to seeing you again on our first quarter 2024. Remember, you can always look at what we said before on our website. Thanks again.